Here we go with another top 5 video because you guys love them so much, and this time we're going to be talking about the top 5 dividend stocks of 2019. And as always, remember timestamps are in the description down below if you want to skip ahead and not watch the whole video. But if you do, please drop a like on this video either way and make sure to share it with a friend as well. By actually doing those things, it actually helps the YouTube algorithm promote this channel much more, and I really do appreciate it. So the top 5 stocks that we're going to be talking about today were all 5 stocks that I tried to actually pick as brand new stocks that we haven't really talked about on the channel before. So again, drop a huge like if you haven't already, if you appreciate that. And also as another requirement for these picks, I look for stocks that had at least a 3% dividend yield. And on top of that, some of these stocks actually have good potential for capital appreciation in 2019. So there's a lot of exciting stuff with this video, so let's get started. Starting off the list here, number 1 is AbbVie. So these guys have over a 5% dividend yield, currently sitting at around 5.39%. So AbbVie, if you haven't heard of them before, is a pharmaceutical company. And to be honest, considering their size, it's really surprising to see that the stock is not really talked about a lot in the investing community. And just to tell you how big they are, they're actually a $120 billion market cap company, and they're actually part of the S&P 500 as well. So if you own some S&P 500 ETF, then you definitely have some exposure to this company in your portfolio already. If you haven't heard about what they do, they're essentially a biopharm company that finds solutions to diseases. And really their mission here is to meet the health needs of people and societies around the world. And I think it's a pretty cool company, and if you have no exposure to the healthcare space, this may be a good stock to consider getting some sort of diversity in your portfolio with. So looking at their financials from 2014 to 2017, we can see that the revenue has actually been increasing steadily up year over year consistently. However, their operating income was flat last year, and the net income actually declined slightly last year. This of course raises the question and has investors questioning their investment, and as a result, the stock price actually took quite a tumble recently. You can see that it dropped all the way down to its 200 moving average on the weekly, and as you can see, 2018 was not really a good year for the stock as it corrected from a high of close to $125 per share, and now currently sits at under $80 per share. But guess what? When a stock price falls, it means that their dividend yield actually increases. And like I said, AbbVie actually sits at a 5.39% dividend currently, so that's a very, very impressive dividend yield from such a large company that actually has a lot of potential moving forward as well. Their dividend payout was roughly around 53% in September 2018, so that's a very sustainable ratio if they can keep going with that. And considering how their dividend has been growing over the last few years with a 3% growth rate of 15%, I suspect that they'll be continuing to pay out their dividends and increasing their dividends in the foreseeable future. Now let's move on to our second pick here, which is Qualcomm. Now I plan to make a much more in-depth video where I go about Qualcomm, the more details about their financials, and kind of just the stock in general. So stay tuned for that as well, and let me know in the comment section down below if you do want to see more info on Qualcomm or 5G stocks in general. So Qualcomm is currently sitting at around a 4.68% dividend yield, which again is a very impressive yield. They're a major player in the 5G space, and even currently with 4G, if you're watching this video on an Android phone, it's most likely powered by a Qualcomm Snapdragon chip. Qualcomm is really the benchmark when it comes to systems on a chips, or SoCs for short. And really the progress that this company has been making with 5G and the developments in 5G has really helped the stock somewhat recover from its highs when it dropped significantly from the dot-com bubble. It's been a pretty slow and painful ride for investors ever since around 2000, but the silver lining here is at least they've been getting dividends out of this investment. Their dividend payout is a bit on the higher side here, sitting at around 71% last quarter, so I don't suspect they'll be raising it much this year, but rather just sustaining it. And when we look at their 3-year growth rate, we can actually see it's slower than AbbVie's, coming in at just under 10%. In my opinion, this is still not too bad considering you're getting good exposure to a major player in 5G as well with Qualcomm. Now their financials are not that impressive, I'll admit, but if you're an investor in Qualcomm, you're not looking at the stock just in 2019, but you're also looking at the stock in the next few, say 3 to 5 years, because that's when you expect the full potential of 5G to really come into effect. As you can see here, revenues have actually been decreasing, but it did go up a bit last year, but their profits have just been taken a beating due to lawsuits and taxes. But this is more short-term pain in my opinion, so I wouldn't be too worried about this as a long-term investor. But anyways, if you believe in the turnaround story here and you believe Qualcomm will be a big player in 5G, then a stock here with above a 4.5% dividend yield is one that you may definitely want to consider. So moving on to our third pick is actually a stock from north of the border, and it's a large banking company up there in Canada, and that's TD Bank. So this is another huge $100 billion plus company, blue chip company, safe company, stable company, and they currently pay out a dividend of 3.47%. TD Bank is actually one of the largest banks in Canada, and they're known for their stability and the safety that the stock provides. And really looking at the stock on a fundamental level here, we can see just how consistent this company is with their growth. Their revenues and net income has just been increasing consistently year over year. Banks do not report their operating income, but I think it's pretty safe to assume here that that has also been increasing at a pretty steady rate year over year. Their payout ratio is also very comfortable, the best on this list so far, coming in at around 42% back in October 2018. But their 3-year growth rate is much lower than the other companies we've looked at so far, coming in at 9.3%. That being said though, TD is actually the most likely, in my opinion, out of all the stocks here to continue their dividend growth for the long term. In my opinion, this company has a lot of money coming in and they can easily pay out more to their shareholders while sustaining the business and growing the business as well. Ever since the 2008 recession, TD has climbed from around $10 per share to around $60 per share, which is an incredible run in just over 10 years. And shareholders not only benefited from the dividends, but they also benefited greatly from capital appreciation here. So this is a perfect example of a stock that not only pays you a good dividend, but also has potential for capital appreciation over the years as well. Moving on to our fourth pick is actually a sin stock, and this is a company that goes by the name of Altria. So sporting a 6.12% dividend yield, the highest actually on our list today, Altria is actually traditionally a tobacco company. And if you're not familiar, they actually own some of the most recognized brands in the space, including Marlboro. And they also recently took a 35% stake in e-cigarette maker Juul to help build out their e-cigarette portfolio to reach even more of the market. In my opinion, whether you agree with their ethics and the morals behind the company or not, looking at the business and the fundamentals of the business, it's really hard to say that this company is not a good investment. Their business on a fundamental level right now is fairly flat, but with their acquisition of Juul, there's a lot more potential for them to start growing at a pretty rapid pace in the future. Currently though, if you look at their revenue, like I said, it's flat year over year. Operating income is up slightly, and net income really took a hit recently, mainly because of taxes, I believe. But in my opinion, this should level off in the next few years, and it should kind of bottom out and start growing once again. Their most recent dividend payout was around 78%, higher than usual, so I personally wouldn't be expecting too much of an increase year over year here with their dividends. And this kind of correlates also to their 3-year growth rate of around 8.3%, which is the lowest out of the 4 stocks we've looked at so far. But really, Altria is at a very attractive price point currently, in my opinion, sitting at just over $50 per share, which happens to be where the 100 moving average is on the monthly chart. We may be oversold here at this point on the stock, and as a result, we're getting a phenomenal opportunity at over a 6% dividend yield by scooping up shares at these prices. I think that Altria actually has very good chances of recovering significantly in the share price department this year. So of course that'll bring down the dividend yield, but if you do manage to get in with over a 6% yield, you'll not only benefit from the dividends, but you also could potentially get some double-digit gains this year with capital appreciation in the stock price. Alright, moving on to our 5th company here is a company that, again, I haven't talked about really on this channel, and you may find this is the most irrelevant company and you may not want to invest in them, but there's a few good things going here with the company that I do want to go over. I would say that maybe in 10 or 20 years this company wouldn't be as relevant, but they do have the opportunity to really adapt their business and maybe create new products, maybe create new services to adjust to the changing world. But anyways, this company is called International Paper, and they currently pay out a dividend of 4.29%. So International Paper is actually one of the world's leading producers of fiber-based packaging, pulp, and paper. Meaning, really in a nutshell, these guys make paper and lots of different types of paper, including packaging paper, commercial paper, printing paper, and much more. They also help recycle paper, which is a great thing that they're doing to reuse what would otherwise be wasted. So like I said, currently the use of paper is slowly decreasing, but when you look at a corporate level, there's still tons of companies out there that use paper, a lot of paper, on a daily basis. Now, there is always the fear that eventually large companies will start banning the use of papers to not only save the environment, but also cut costs. And as a result, if you're one of those individuals using paper at that point, it may be looked down upon. And really at that point, most people would actually switch off of using paper, in my opinion. But that being said, the concern about, companies not using paper anymore in the near term isn't isn't really too much of a concern to me. I think over the very long term, say 10-20 years, this is a possibility. But as of right now, this is looking like a pretty good stock, a pretty good investment, pretty safe investment, and has a pretty good dividend yield like we talked about. So their payout is actually at a pretty reasonable 65% right now, but their growth rate isn't looking too impressive at around a 5.5% for the last 3 years. Again, these numbers are not all that impressive, but I believe the stock has great current value from where the current share price is sitting at, so that gives you another potential for capital appreciation. But before we get into the charts to actually see where the stock is sitting at, let's take a look at their fundamentals here at a quick overview level, and we can see that their revenue here did take a dip a couple years ago, but has since recovered. But when you look at their profits, they have been moving in the right direction. This shows that they're efficient with their investments in capital and can bring in more profits with declining revenue, and that's always a good thing to see as an investor because the company is much more efficient with pumping out those profits. And now finally, if we look at their charts, we can see that they recently tested a major support level, the 200 moving average on the monthly, and it held once again. The last time we were below this was during the 2008 recession, and since then we came down and tested it once in 2016. At current prices of under $50 per share, International Paper sits at a PE of below 12, making it not only a good play for potential profits, but from the stock price rising as well. But with dividends of over 4%, it adds even more value to shareholders, even if you're just in it for the dividends. So if you enjoyed this video, make sure to take 2 seconds down below, drop a like, share this with a friend, and leave a comment as well. Like I said, it really helps the channel and it really helps YouTube algorithm push this video out to more viewers as well. Let me know which of these 5 stocks, if any, you hold in your personal portfolio, or which ones you may consider adding to your portfolio. If you want to see what I hold in my portfolio, link is in the description down below to the VIP membership group. Either way, guys, thank you so much for watching. Thank you so much for sticking around to the end here. Hope you enjoyed this video. Don't forget to invest positively, and I'll see you in the next one. Peace.